the evening of January 18th, 2026. The weekend markets are closed. The noise from Friday has settled. And if you've been following silver this week, if you've been watching what I've been watching, then you know something just shifted. Not in the charts, not in the price action, but in the narrative. Because yesterday, on January 17th, a senior commodity strategist at Bloomberg Intelligence said something out loud that changes the entire conversation. And I need to walk you through exactly what he said, why he said it, what it really means, and most importantly, what nobody else is telling you about the implications. I'm a private commodities analyst. I've been trading these markets for 12 years. I built this channel because I got tired of the mainstream financial media either missing the story entirely or spinning it in a way that protects the institutions at the expense of regular investors like you and me. And I use this AI avatar for one reason: speed. When something breaks, I can get you the analysis faster than anyone else. No production delays, no waiting for approval from some network executive. Just the data, the context, and my honest interpretation. Tonight, I want to connect some dots for you, because what Mike McGlone said yesterday isn't just another analyst opinion, it's a signal. And when you combine it with what happened on Friday during OPEX, when you look at the math, when you understand the historical context he's referencing, you start to see a picture that should make every silver investor sit up and pay very close attention. Here's the hook. Mike McGlone, senior commodity strategist at Bloomberg Intelligence, posted on X yesterday that silver may set a multi-year high in 2026, if history is a guide. He called silver a 3 sigma asset. And he compared the current setup to the last time we saw these conditions, which was 1979, the year the Hunt brothers tried to corner the silver market. Now, let me say that again. A Bloomberg strategist is publicly comparing today's silver market to one of the most explosive, most legendary moves in commodities history. And the mainstream financial media? Crickets. Nobody's talking about this. Nobody's breaking down what 3 sigma actually means. Nobody's explaining why the Hunt brothers comparison is so significant. Nobody's connecting this to what just happened on Friday during monthly options expiration. That's why I'm here. That's what we're going to do tonight. Here's the conflict. On one hand, you have McGlone suggesting that silver could hit $100 and set a peak for years. On the other hand, you have miners that are still priced like silver is at $30. You have institutional short positions that are bleeding. You have a paper market that's completely disconnected from the physical reality. And you have a media establishment that refuses to give you the full picture. So, which is it? Are we at the beginning of the final push higher? Are we nearing the top? Or is there something more nuanced happening that requires you to be extremely careful about your timing? That's what I'm going to break down for you over the next 30 minutes. And here's my promise. I'm going to explain what 3 sigma means and why it matters. I'm going to show you the historical parallels that McGlone is referencing. I'm going to walk you through what happened on Friday during OPEX and how it connects to this new development. And I'm going to give you my personal battle plan for navigating what I believe is the most critical phase of this entire silver cycle. Let's start with the data. Yesterday, Mike McGlone shared a chart showing silver's position within a long-term rising trend channel. And he pointed out that the metal is currently pressing against the upper statistical bands of that channel. The same bands that marked previous major peaks. The same bands that preceded extended periods of consolidation or outright reversal. This isn't bearish analysis. This is historical pattern recognition. And McGlone isn't some random Twitter account. He's a senior strategist at Bloomberg Intelligence with access to institutional-grade data. When he speaks, the smart money listens. But here's what most people missed. 2 days before that post, on January 15th, McGlone shared an even more detailed analysis. He said that about 75 ounces of silver are now equal to the S&P 500. That ratio is the lowest since 2013. Think about that. It now takes fewer ounces of silver to buy the entire S&P 500 than at any point in the last 13 years. That's not just a random statistic. That's a measure of relative valuation. That's telling you that silver has outperformed equities so dramatically that we're in rarefied territory. And it gets more extreme. McGlone pointed out that silver is currently trading at 3.2 times its 60-month moving average. The 60-month moving average is a 5-year smooth price. It filters out all the short-term noise and shows you where the metal has been trading on average over a long time horizon. Right now, silver is more than 3 times above that average. And here's the kicker. The last time silver was this stretched above its 5-year moving average was 1979. The Hunt brothers, the corner attempt. The blow-off top that led to one of the most famous crashes in commodities history. Now, before you panic, before you think I'm telling you to sell everything and run for the hills, let me give you the full context. Because McGlone isn't saying silver is about to crash. He's saying silver could hit $100 and then set a peak that lasts for years. There's a massive difference between a crash and a multi-year peak. A crash implies a violent, sudden collapse. A multi-year peak implies we could reach a high watermark that takes years, maybe a decade, to revisit. One is a disaster. The other is an opportunity if you know how to navigate it. And here's what the mainstream won't tell you. Even if silver peaks in 2026, even if we're approaching the final stages of this move, there's still potentially significant upside left. The Hunt brothers' peak in 1980 came after a parabolic move from $6 to $50. We've gone from $20 to $91. Is there room to run to 100, 120, 150 before the cycle ends? I believe there is, but timing matters, positioning matters, and understanding the mechanics of what's happening right now matters more than ever. Let me teach you what 3 sigma actually means, because this is the key to understanding McGlone's analysis. In statistics, sigma refers to standard deviation. It's a measure of how far a data point is from the average. 1 sigma means you're 1 standard deviation away from the mean. And about 68% of all data points fall within 1 sigma. 2 sigma means you're 2 standard deviations away. About 95% of data points fall within 2 sigma. 3 sigma means you're 3 standard deviations away. Only about 0.3% of data points fall this far from the mean. When someone calls silver a 3 sigma asset, they're saying it has moved to a statistical extreme that occurs less than 1% of the time. Historically, these extremes don't last. They either correct back toward the mean, or they mark a transition point to an entirely new regime. And here's the thing about 3 sigma events. They're not predictive of direction, they're predictive of volatility. They tell you that something unusual is happening, that the current state is unsustainable, that change is coming, but they don't tell you whether that change will be up or down. That's where context matters. That's where you need to understand the underlying fundamentals, the positioning, the flow of capital. Let me connect this to what happened on Friday, January 16th. Monthly options, expiration, OPEX. I talked about this in my video on the 15th. I said there would be massive volatility. I said the $90 level would be defended aggressively. I said the miners would show relative strength if the suppression mechanism was breaking. And here's what actually happened. Silver opened weak. We saw selling pressure in the early session. The banks tried to push the price down through the $90 support level. They wanted to trigger stop losses. They wanted to force those call options to expire worthless. But the floor held. By midday, we saw aggressive buying. The V-shaped recovery I predicted materialized, and the miners, the actual companies digging this metal out of the ground, finished the day with relative strength compared to the metal itself. That's not a coincidence. That's smart money stepping in. That's the floor being defended. That's the signal that the suppression is failing. And now, less than 48 hours later, we have a Bloomberg strategist publicly comparing this market to 1979. The pieces are falling into place. Here's what I think is really happening. We're in the acceleration phase of a major precious metal cycle. Silver has already done the heavy lifting. It went from $20 to $91 in about 18 months. The easy money has been made. But the biggest money, the generational wealth transfer money that comes in the final phase, the blow off top, the moment when retail finally wakes up, the moment when the media can no longer ignore the story, the moment when your neighbor who never invested in anything starts asking you about silver. We're not there yet, but we're getting close. And McGlone's comments suggest that the smart money is starting to position for the end game. They're acknowledging that we're in extreme territory. They're acknowledging that a peak could come this year, but they're also acknowledging that the peak hasn't arrived yet. There's still room to run. Now let me address the skeptics, because I know some of you are thinking this sounds too good to be true. Skeptic argument number 1. If a Bloomberg strategist is calling a top, doesn't that mean you should sell? Here's my rebuttal. McGlone isn't calling a top. He's calling a potential peak within the year. There's a difference. He's saying silver could hit $100 and then set a multi-year high. That implies there's still upside. That implies the $100 target is achievable before the cycle ends. And here's the thing about Wall Street analysts. They're not trying to help you time the exact top. They're giving you a roadmap. They're telling you the destination is approaching. What you do with that information is up to you. Skeptic argument number 2. The Hunt brothers comparison is scary. They went bankrupt. Here's the context that matters. The Hunt brothers didn't go bankrupt because silver went up. They went bankrupt because they were massively leveraged, they got margin called, and the exchanges changed the rules in the middle of the game to stop them. If you're holding physical silver, if you own mining shares outright without margin, if you're not trying to corner the market with borrowed money, the Hunt brothers comparison is irrelevant to your situation. McGlone is using that reference to illustrate how extreme the current deviation from trend is. He's not saying you're going to suffer the same fate as Nelson Bunker Hunt. Skeptic argument number 3. 3 sigma extremes mean reversion is coming. Shouldn't I sell now? Here's the nuance. Yes, 3 sigma extremes tend to correct, but they don't correct immediately. and they don't correct in a straight line. The 1979-1980 move went to 3 sigma and then kept running for months before the top was in. The 2011 move went to 3 sigma and kept running for weeks. These statistical extremes tell you that you're in the danger zone, that you need to be vigilant, that you should have an exit plan. But they don't tell you the exact day or the exact price where the music stops. Here's what I'm watching right now. First, the price action at $92 to $95. If silver can hold above 92 and start making higher highs, I believe we're in the final push toward 100. That's the psychological target. That's the round number that will attract media attention and retail FOMO. If we break below 88, I'll start to get cautious. That would suggest the 3 sigma correction is starting earlier than I expected. Second, I'm watching the miners versus the metal. On Friday, the miners showed relative strength. If that continues next week, if we see the silver mining ETF outperforming silver itself, that's a sign the catch-up trade is accelerating. That's where I believe the best risk-reward is right now, not in the metal, but in the equities. Because even if silver consolidates near these levels, the miners have so much catching up to do that they could still double or triple from here. Third, I'm watching the dollar. The DXY has been weak recently. If that weakness continues, it's rocket fuel for precious metals. It makes gold and silver more attractive to foreign buyers. It amplifies the move. Fourth, I'm watching the institutional positioning. The commitment of traders report. The short interest in key mining stocks. The options open interest at critical strike prices. These are the tells that show you what the big players are doing. Let me give you some historical context that nobody else is talking about. In 1979, when silver was at these 3 sigma extremes, the metal was trading around $16. By January 1980, it hit $50. That's a 212% move in about 6 months. If we're in a similar situation today, if silver is at 91 and the 3 sigma extreme marks the midpoint rather than the end, a similar percentage move would take us to over $280. I'm not saying that's going to happen. I'm not making a price prediction. I'm just showing you the math. I'm showing you what happened the last time we were in this situation. And I'm asking you to consider the possibility that the move isn't over, that the best is yet to come, that the media blackout on this story is intentional because the institutions haven't finished accumulating their positions. Here's something else McGlone mentioned that deserves attention. The silver-to-S&P 500 ratio. At 75 ounces, this is the lowest reading since 2013. But let me put that in context. In 2011, at the peak of the last silver bull market, the ratio got down to about 20 ounces. That means you could buy the entire S&P 500 for just 20 ounces of silver. If we're heading toward a similar extreme in this cycle, silver would need to almost quadruple from here relative to equities. Either silver goes up dramatically, or the S&P crashes, or some combination of both. That's the math. That's what the ratio is suggesting as a possibility. I'm not saying we'll get to 20 ounces, but I am saying that at 75 ounces, we're nowhere near the kind of extreme that marked the 2011 top, which suggests there's still significant room for silver to outperform equities in the months ahead. Now let me tell you my personal battle plan for the next few weeks. And I want to be very clear. I'm not telling you what to do. This is not financial advice. This is just how I'm navigating this complex and volatile environment based on 12 years of experience. Number 1, I'm holding my core positions, physical silver, mining shares. I'm not selling into this move. I believe the final phase is still ahead of us. I believe $100 silver is achievable, and I want to be positioned when it happens. Number 2, I'm adding to my miner positions on any weakness. If we get a pullback to 88 or 85 on silver, I'm treating that as a gift. I'm backing up the truck on the mining ETF because the operating leverage thesis I laid out in my previous video is still intact. These companies are printing money at current prices. They're the most undervalued sector in the entire commodity complex. And when the catch-up happens, it's going to be violent. Number 3, I have a mental stop loss. If silver closes below 80 on a weekly basis, I'll reassess. I won't panic sell, but I'll reduce position size and wait for the dust to settle. That's my risk management. That's the level where I admit I might be wrong about the timing. Number 4, I'm watching for the euphoria signals. When my Twitter feed is full of rocket emojis and people who've never invested in anything asking me about silver, that's when I start scaling out. When CNBC does a feature story on silver hitting $100, that's when I take profits. When the narrative shifts from skepticism to mania, that's when the smart money exits and the retail bag holders get created. I refuse to be a bag holder. Let me zoom out and talk about the bigger picture. Because this isn't just about silver, this is about a fundamental shift in the global monetary system that's been building for decades and is now accelerating. Central banks around the world are buying gold at record rates. The BRICS nations are actively working to reduce their dependence on the dollar. Inflation, despite what the official numbers say, is still eating away at purchasing power. And the debt levels in the United States and Europe and Japan are completely unsustainable. In this environment, precious metals aren't just a trade, they're insurance. They're a store of value that has survived every currency collapse, every empire's decline, every financial crisis in human history. And silver, specifically, has the added benefit of industrial demand. Solar panels, electric vehicles, electronics, medical devices. The green energy transition requires silver. Physical demand is growing while supply remains constrained. That's the fundamental backdrop that's driving this move. That's why we've gone from $20 to $91. And that's why I believe the move isn't over, despite the 3 sigma extreme. Here's what bothers me about the mainstream coverage. When silver was at $20, nobody talked about it. When it hit $30, they called it a dead asset. When it hit $50, they said it was a bubble. When it hit $70, they were silent. And now, at $91, with a Bloomberg strategist publicly comparing it to the Hunt brothers era, the media is still quiet. They're not telling you about the 3 sigma extreme. They're not explaining what it means. They're not connecting the dots between McGlone's analysis and the options expiration we just went through. They're not helping you understand how to position for what's coming. And that's intentional, because the financial media isn't designed to help you make money. It's designed to keep you watching, to sell you advertising, and to protect the interests of the institutions that are their real customers. That's why I built this channel. That's why I'm here at 9 p.m. on a Saturday night recording this for you. Because someone has to tell the truth. Someone has to give you the analysis that actually matters. Someone has to connect the dots that the mainstream refuses to connect. Let me address one more thing before I wrap up. Some of you are probably wondering whether you should buy silver here or wait for a pullback. Here's my honest answer. I don't know. Nobody knows. If I could perfectly time the market, I'd be on a yacht somewhere instead of talking to a camera. But here's what I can tell you. Waiting for the perfect entry is a game you'll never win. There's always a reason to wait. There's always a possibility of a pullback. And while you're waiting, the market moves without you. My approach is to accumulate on a regular basis, to buy weakness when it presents itself, to never go all in at once, and to always have dry powder for opportunities. If silver pulls back to 85, I'll buy more. If it never pulls back and just rips to 100, I'm still positioned to benefit from my existing holdings. That's how you play a volatile market. You don't try to be perfect, you try to be positioned. Here's my 3-sentence recap. A Bloomberg strategist just compared silver's current market to the Hunt brothers era of 1979, calling it a 3 sigma extreme that hasn't been seen in 47 years. The silver-to-S&P ratio is at its lowest since 2013, and the metal is trading at 3.2 times its 5-year moving average, suggesting we're approaching either a blow-off top or a generational peak. The miners are still priced for $30 silver and represent the most asymmetric opportunity in the precious metals complex. That's the situation. That's what McGlone is telling you if you know how to read between the lines. And that's why the next few months could be the most important of this entire cycle. Let me leave you with one final thought. Markets move in cycles. They go from fear to greed and back again. They go from undervaluation to overvaluation and back again. Right now, precious metals are transitioning from undervaluation to something else. We're not at maximum greed yet. We're not at the point where every taxi driver is recommending silver, but we're getting there. And when we arrive, when the 3 sigma extreme finally resolves, when silver hits its multi-year high that McGlone is predicting, there will be winners and there will be losers. The winners will be the ones who understood what was happening, who saw the signals, who positioned accordingly, who had an exit plan. The losers will be the ones who ignored the signs, who bought at the top out of FOMO, who held too long because they believed the number could only go up forever. I intend to be in the first group. I hope you'll join me there. Next week is going to be critical. Monday morning, I'll be watching the tape from the opening bell. I want to see how the market digests McGlone's comments. I want to see if the mainstream picks up the story or continues to ignore it. I want to see whether the miners extend their relative strength from Friday or give it back. And I'll be back with updates as the situation develops. If something major breaks, if we get the move I'm expecting, you'll hear from me. If I'm wrong, if the 3 sigma correction starts sooner than I expected, I'll tell you that too. Because that's how you build trust. That's how you build credibility. Not by pretending to be right all the time, but by being honest about what you see and admitting when you're wrong. Things are moving fast. The mainstream is finally starting to acknowledge what we've been discussing for months. The statistical extremes are flashing warning signs. The opportunity is still there, but the window is narrowing. Pay attention to the signals. Ignore the noise. And remember, in markets like this, the biggest gains come to those who are positioned before the crowd shows up. And the biggest losses come to those who stay too long after the crowd arrives. I'll be monitoring the situation in real time. If you found this analysis valuable, subscribe and turn on notifications. Go back and watch my previous video on the OPEX suppression mechanism if you want to understand how the paper market manipulation works. And I'll see you on the next update. Until then, stay sharp, stay disciplined, and stay frosty.